Hey everyone, welcome to Vintage Capital. This channel documents my journey growing a $20,000 portfolio from the ground up using long-term investing and income strategies like covered calls. Over the past 5 years, I've built my first portfolio with an average return of over 20% per year. And now I'm applying that same philosophy here. So I'm starting with $20,000, which I deposited about a month ago, and contributing $175 every 2 weeks. And the goal is simple. It is to grow this account to over $100,000 by buying great businesses at smart prices and turning them into income producing assets over time. Now, my investing approach focuses on buying high quality companies with predictable growing revenue, strong free cash flow, low debt, high returns on capital, and that they also have a long runway for growth. Now, I don't just buy these company whenever. I buy them when they are at great deals, great prices, which I believe it's when they are undervalued and their metrics such as the PE ratio or the free cash flow yield compared to its historical valuations or compared to its growth expectations. Another times that I buy is when they're on a major dip or when they're at key support levels such as the 50 or 200-day moving average, and also if they're on an uptrend. And then finally, my strategy is to accumulate 100 shares of these companies so that I can generate income by selling covered calls. Now, the first company I bought for this portfolio is Google. I bought 100 shares of Google about a month ago at 173, around $173. Now, why did I buy Google? It's because I believe it's currently undervalued and it's going to keep growing into the future. Now, Google, I believe, is a high quality company because it has predictable growing revenue every year. It goes up. It generates immense amount of profits consistently every single year. It has very low debt. If we look at the debt to EBITDA, it's 0.2. It's one of the lowest in the market. And it has a long runway for growth with other properties such as Google Search, YouTube, Google Cloud, Gmail, Android phones, and Waymo. Now, this year, Google is down. It's actually down around 9% since the start of the year. And it's currently at around $175 per share. And I believe that Google should actually be at around $220 per share. And over the next decade, I believe that Google will grow to be around $600 per share. So that means that the 100 shares that I bought for around $17,000, I believe that over the course of the next 10 years, this will be worth around $60,000 per share. No, $60,000 total. Now, because I have 100 shares of Google, I can also start generating extra income by selling covered calls. And since I bought the company, since I bought the 100 shares, I've already generated $105, and then Google also paid me a dividend. That means if I did this every 2 weeks, I will be generating an extra $1,200 a year just by owning the stock. Doesn't even take into account the price appreciation. Now, why do I think that Google is currently undervalued and on a dip? Well, first, it has to do with government antitrust lawsuits that hit them earlier this year. That could potentially break up Google search. And another aspect is that AI, like new AI applications like ChatGPT, are growing exponentially, and investor fears that these will replace what we typically do in the internet, which is the Google search. Now, I think that both of these fears are overblown, and honestly, who's going to stop using Google search? Who's going to stop watching things on YouTube using Gmail and Google Cloud? And these AI tools have been present for about a year now, and Google's revenue, if we look at it over a quarterly basis, keeps going up. It's not really affecting it. It's already grown 12%. So I think that if these fears of a ChatGPT AI tools were to be affecting Google, we would already see it in the revenue, but that's not playing out like that. All right. So also, Google has a long runway for growth and optionality, meaning that they can create new businesses out of nothing. For example, they have Waymo. Waymo is the new autonomous ride sharing, like an Uber, that they have their own cars that they drive themselves. People get in them, and they are growing massively. Like they're they're like have more rides than Lyft in San Francisco. Imagine when that just expand all over the world. Google has Google Maps. These cars can learn everything about the environment, about the roads, and with AI advancing even more and more, we won't need to be driving cars. So that means more revenue for Google and a lot more profits. Now, I'm going to keep contributing $175 every 2 weeks and continue building positions in high conviction companies when they are at great prices, good valuations. The next one that I am looking at building a position in is Amazon, but I'll talk about that in a separate episode. But I'm not a financial advisor, and nothing in this video is financial advice. This is just my real investing journey. My goal is to grow this portfolio step by step and share the thinking behind every move. Now, if you're into long-term investing, building wealth, and making your money work for you, hit like, subscribe, and comment below. Do you think Google is undervalued right now? I'd love to hear your take.